Welcome to the Deep Dive. Today, we're really digging into Rajratan Global Wire Ltd, some recent corporate moves, and of course their Q2 financial results. For anyone maybe less familiar, Rajratan makes bead wire. It's like a critical component, that high-strength wire inside modern tires, a big global player. So we have two sets of documents here. The official regulatory filings about board decisions can be a bit dry but important. And then we have their investor presentations. That's where you find the story, the strategy behind the Q2 numbers for fiscal 26. Our job today, get past just reading the numbers. We want to understand the story of what changed operationally, finding the real pivots.
Yeah, and if you actually look closely at the sources, the headline numbers, they only give you part of it. I mean, yes, volumes hit all-time highs, which is great. But the really interesting bit, the thing the chairman keeps highlighting, is this operational turnaround they pulled off. They're calling it a game changer, which suggests, it wasn't just growth. They fundamentally changed how they operate.
Right, a structural shift. That's always much tougher than just, well, selling more stuff.
Yeah.
So let's start there with the structure. Before we even get to the rupees and lakhs, what about the non-financial news? They changed their MOA and AOA, the Memorandum and Articles of Association. Why is a wire company messing with its founding documents?
Well, this is actually a pretty clear signal about their future plans or operational strategy, maybe. This change, it still needs shareholder approval, mind you, but it's all about complying with India's electricity rules from 2005. It basically gives them the official green light to generate their own electricity and, crucially, use it themselves, captive consumption, using things like solar and wind. Non-fossil sources.
Ah, okay. So I'm reading that as this isn't just about PR, like looking green. This is practical. It's about locking in energy cost, securing supply.
Exactly. Think about it running massive plants in India, Thailand. Energy is a huge operational cost, a variable one. If they generate their own green power, they're hedging against rising grid prices. It's a very concrete move to control a core input cost for years to come.
Okay. And the sources show they're already acting on it.
Yep, straight away. The board approved putting up to 2 crores rupees into a solar power company.
2 crores. So for our listeners, that's 20 million rupees, roughly 240,000 US dollars. Seems specific.
It is specific. It's tailored to get them just the right percentage stake they need under the Electricity Act for this group consumption model. It's a small key to unlock a bigger energy strategy.
And does this tie into anything else they mentioned?
Oh, yeah, absolutely. It connects directly to their sustainability goals mentioned later in the docs. They've already got solar running in Thailand, apparently, and they're putting in more solar at their new Chennai plant. So this MOA change just sort of formalizes and enables that whole green energy plan end to end.
Okay, that definitely sets a strategic tone. Energy independence, sustainability. Now, let's see how the operations actually performed in Q2 fiscal 26. What did the financials look like at a high level?
Well, the top line looked really strong. Consolidated revenue, up 20% compared to the same quarter last year. Hit ours 29,417 lakhs, which, just to ground that, is nearly 294 crores, or maybe $35 million US for the quarter, so significant revenue. And net profit after tax, Petty, that also grew, up 8% year-on-year to ours, 2,055 lakhs. So, growth on both fronts looks good initially.
Okay, but digging a bit deeper, there's a key operational metric that tells a slightly different story, right? Revenue up 20%, but EBITDA, that only grew 6%.
That's the catch. That's where you see the pressure. Usually with a 20% revenue jump, you'd hope to see EBITDA climb faster, or at least keep pace because of operating leverage. But here, the EBITDA margin actually squeezed. It dropped from 15.44% last year down to 13.60% this quarter. It's a noticeable dip in operational profitability relative to sales.
Wait, but hang on. Didn't the sources say raw material prices, steel specifically, were actually softer in this period? Normally, lower input costs would help margins, not hurt them. So why the squeeze? Why didn't they keep that benefit?
Yeah, that's the million-dollar question, isn't it? It boils down to competition. The chairman's comments are pretty clear on this. Even though their own steel costs came down, they couldn't hold on to that margin because the market was just too fierce. They had intense pressure from other Indian players and international competitors, too, so they had to lower their selling prices. Moderate realizations is the term they used. Basically, they chose volume and market share over maximizing the margin in the short term, had to pass on those cost savings.
Okay, so it was a trade-off. Fierce competition forced their hand on pricing, even with lower steel costs, which actually makes the next part, this operational turnaround, seem even more crucial. They needed something big just to get that 8% profit growth. Let's talk about Chennai, the game changer.
Exactly, the Chennai plant. It's their new greenfield unit. Phase 1, with 30,000 tons per annum capacity. This was clearly the big strategic play for the quarter. And what's really impressive, I think, is the speed. They got this massive new plant profitable within just 12 months of finishing the trial run back in April 2025. I mean, for a big industrial project like that, going from commissioning to making money in a year, that's exceptionally quick execution.
Wow, okay. A year turnaround time is fast. Suggests they had customers lined up and ready to go. What kind of production levels did they hit in Q2 to make that happen?
They mentioned hitting 60% capacity utilization in the second half of Q2, which is pretty good, pretty fast ramp up. But the real smart part wasn't just filling the plant, it was how it changed their whole network. See, Chennai was built mainly to serve customers nearby in the south of India, key customers close by. And by doing that, it basically took the pressure off their older main plant in Pithampur, which is more central India. It liberated Plintham, as they put it.
Liberated Pithampur. Okay, what does that mean in practical terms?
It means Pithampur wasn't tied down just shipping stuff south anymore. It was free to chase other business, maybe further away, maybe higher value markets, more profitable stuff. So this geographical shuffle optimized their whole domestic logistics, saved money on transport, cut down delivery times. It's like a network effect, making both plants more efficient together.
Right, a ripple effect. And Chennai was just about fixing domestic logistics, was it? The sources mention exports too.
Precisely. That's the other layer here. From day one, Chennai was also geared for international sales. And get this, it generated 33%, a third of its revenue from exports already.
A third from exports straight out of the gate. That's significant.
Very. It helps them hedge against ups and downs in the Indian market, diversifies their risk. It was a really multifaceted strategy with Chennai, fix logistics, boost exports all at once, and they pulled it off.
And that execution definitely shows up in the overall volume numbers. Let's just state those records because they are pretty remarkable for this industry.
Yeah, they really are. They didn't just beat their old record. They blew past 32,000 metric tons for consolidated sales volume in a quarter for the first time. The final number was 32,887 MT. And if you look just at their main product, bead wire, that also hit its highest ever sales volume across all their plants, 29,003 MT. Just massive numbers.
Huge volume. And a good chunk of that global picture still relies on their setup in Thailand, right?
Yeah.
How did the Thai subsidiary do, especially with all that talk of Chinese competition?
Thailand held up incredibly well, actually. Showed real resilience. They ran the plant at 91% capacity utilization. That's almost flat out. And despite what they called sustained Chinese competition, the Thai unit stayed profitable. Sales volume there grew 5% year on year, hitting 12,071 MT.
91% utilization and profitable against Chinese competition. How'd they manage that? Did they just slash prices?
No, actually the opposite, which is interesting. They strategically shifted up. The sources say they managed to sell those higher volumes at better realizations, better prices. How? By increasing the share of premium bead wire in their sales mix. So focusing on the higher spec, higher margin stuff, where maybe quality matters more than just the lowest price, fighting commoditization.
Okay, so zooming out then. The big picture was tough. Trade uncertainties, maybe tariffs impacting U.S. exports, plus lots of new bead wire capacity coming online globally. A challenging environment. But Rajratan's response wasn't to retrench. It was this complex Chennai execution, optimizing India, pushing premium products in Thailand.
That really nails it. The market reality, softer prices, kind of forced their hand.
Yeah.
But their operational response, especially Chennai turning profitable so fast, that became the engine. It drove those record volumes and helped them, overcome the margin pressure enough to still deliver decent profit growth.
So looking forward then, Chennai's up and running, profitable, scaling. What's the company expecting for Q3 and beyond? Are they counting on this momentum to continue?
Yeah, management sounds pretty optimistic about sustaining the momentum. They seem to be banking on three main things. First, just continued ramp up at Chennai, higher sales volumes, higher utilization. Second, as those Chennai sales grow, the fixed costs of that big new plant get spread over more tons. So better cost absorption, which should help margins recover over time. And third, they seem to expect raw material costs, particularly steel, to remain sort of stable or at least contained for the next half year or so.
Makes sense. And let's quickly loop back to the beginning, that MOA change for green power. How does that fit into their broader sustainability picture going forward? It wasn't just a one-off investment, right?
No, it seems like part of a bigger philosophy. They talk about enhancing resource efficiency things like using recyclable packaging, reusing chemicals in production, standard efficiency stuff. but important. Then there's the green energy push we talked about, solar done in Thailand, being installed now in Chennai. And critically, they also mention setting realistic net zero targets aligned with industry standards. So it seems like they're trying to embed sustainability across the board operationally.
Right. So for you listening, trying to track manufacturers like this, what's the real takeaway? I think it's that you can't just look at the profit number or even the revenue growth alone. This company, Rajratan, pulled off a really smart strategic pivot. They used that huge Chennai investment not just to add capacity, but to solve multiple problems at once. Margin pressure, messy domestic logistics, and needing more export diversification. They didn't just get bigger, they arguably got structurally stronger, more resilient.
Exactly. And that leads to a really interesting question for you to keep an eye on going forward. The chairman specifically mentioned potential GST rationalization, basically tax changes on tires and cars in India as a possible big boost. So the question is, now that Rajatan has optimized its Indian manufacturing with Chennai freeing up Pithampur, how much more growth could they capture from that potential domestic demand surge if the GST changes actually happen? Could that policy shift basically supercharge the operational gains they've already made? That interaction between their improved structure and potential market stimulus, that's definitely something to track over the next 6 months.
Absolutely. A potential catalyst meeting a newly optimized machine. Something to watch very closely indeed. Well, thank you for joining us for this deep dive into what turned out to be a pivotal quarter for Rajratan Global Wire. We'll catch you next time.